Okay, so now we're going to talk about the forward and futures on commodities. Now, commodities is a type of consumption asset. And at the beginning of the session, when we're talking about futures and forwards, we discussed that the prime difference between an investment asset and a consumption asset is, in case of consumption assets, you would have a lot of other extra costs in the form of, let's say, storage cost, transportation cost, wastage cost. So all those things would be built into the pricing formula. So on one hand, where the investment assets were giving you dividend, the income, in case of commodities or consumption assets, they would be cost. So the formula intuitively would become S naught plus U. So instead of S naught minus I, where I was the present value of future income, here you'll add the cost, because remember, cost will always be added, income would be adjusted against the cost. So your F naught, which is my forward or futures price, would then become S naught plus U. U is the present value of future cost, which could be storage cost, which could be any, let's say, transportation cost. If it is in yield form, you will add it to R. So basically in that case, it will be S naught e to the power R plus U into T, if U is in percentage form. So let's solve this question. So in this particular case, I have a futures contract. I want to find the price of a futures contract which is expiring 1 year from now, and it provides no income. However, it costs 2 rupees or $2 to store the asset, and the payment is made at the at the end of the year. The spot price is 450 and the risk free rate is 7%. So my spot price is 450 and there's a cost of $2 which I have to pay at the end of the year as a storage or as a storage cost. So I'll first find the present value of 2, add it to 450, and then whatever that value is, so 450 plus present value of 2, I will compound this with 1 year, so 7% into 1. So U comes out to be 1.865, and you adjust this formula, this will become 484.63. Now lease rates are the lease rate for an investment commodity is the interest rate charged to borrow the underlying asset, and this is generally done when you are dealing with investment banks. So a gold producer might enter into a contract with investment bank to sell its future production using the forward contract as of today at a given price, the way a forward contract works. And the bank will then hedge its risk by taking on uh, using gold price by borrowing gold at a lease rate for the time which is equal to the forward rate, and selling the spot price or selling the gold in the spot market for certain time period. So the formula for lease rate is also very similar to your currency one, right? So here S is my current commodity rate, spot rate, R is my risk free rate, and L is my lease rate. So let's take this question on lease rate also. So in this particular case, as you can see, my risk free rate is 4% and the spot price is 1240. The time period is 6 months. The futures price is 1250. So 1250 is 1240 into 1 plus 4% upon 1 plus lease rate to the power of 0.5. So if you solve it, L comes out to be 2.3%. Now convenience yield is when you physically own any commodity, let's say crude oil or any other asset, there's some kind of operational benefits which can be used in production. And that benefit is essentially by holding that particular commodity. So your formula then would adjust this convenience yield with the cost. So if R is my cost and Y is my convenience yield, then my forward price would be S naught plus present value of storage cost into e to the power R. Now R would be adjusted against the income, which is my convenience. So R minus Y into T. In case if U is also in percentage form, then F will be S naught e to the power R plus U minus Y into T. So this is the formula in case if the storage is also in percentage. So cost of carry refers to cost of holding the asset till maturity. This would include your storage cost or interest paid to acquire the asset. So the convenience yield refers to any income derived by holding the asset. And the net of these two is called net cost of carry. So convenience yield should decrease the cost of financing the underlying asset, hence it is subtracted. As I was saying, your convenience yield will be subtracted from the cost because it is a benefit which you are deriving. Now, what is backwardation and contango? Contango is where the current futures price is greater than the spot price, which is the normal case which has been happening in all our discussion, where the futures price is greater than the spot price. Backwardation happens when reverse happens where the futures price goes below the spot price, right? So in a very normal scenario, your contango will always happen because futures will always be more than the spot, whereas backwardation is in a very rare case. The term was coined by John Maynard Keynes, the famous economist, uh, who said that it's very normal for a commodity market to get into backwardation, but then historically speaking, there has been only 4 or 5 events where the markets have actually gone into backwardation. So one of the reasons why commodity market can go into backwardation is during times of famine or drought, where the spot price of the asset shoots up with respect to the futures price. Because if the market expects that the futures would remain stable, but the spot price would essentially cater to the demand, and if there is very less supply and very high demand of, let's say, wheat, which is my commodity, then in the current market the spot price will suddenly shoot up. But then if I am foreseeing that in the next 2 or 3 months the prices would stabilize, then the futures might not rise to that extent, and that is where the backwardation will come into play. So a normal futures curve will show a rising slope as the price of futures rises. As we have seen, more time to maturity, more is the futures price. So the futures price will always go up with maturity. A 2 months futures will always be more than 1 month future. A 3 months futures price will always be more than 2 months futures price. Now, as we are saying that when the futures is below your spot price, then it's backwardation. When futures is above your spot price, it is contango. An inverted future curve happens when the long term futures contract are below the short term futures contract. So, for example, if 1 month futures price is more than, let's say, 6 months futures price, or 1 month is more than 2 months futures price, then it's a sign of backwardation. So this is all that we have summarized so far, where we talked about the formula of futures and forwards with income, with no income, with income in cash form, with income in dividend form, and correspondingly, what are our value of the contract. So this essentially completes the chapter on futures and forwards. When we started with the basics of forwards and futures, we moved towards a typical operations of a forward and futures. We talked about different aspects of futures, from hedging to arbitrage, and then finally we concluded with backwardation and contango. So, with this in mind, we'll now move towards fixed income from our next session, where we start with very basic concepts on interest rates, and then we'll advance it to a more complex examples, which would include treasury bond, treasury bills, and how do you price these two, and then futures on treasury bonds. So we'll meet in the next session where we'll start with the basics of fixed income, starting with interest rate calculation. Thank you. See you in the next session.